Hi guys, welcome to my channel. So before we get started, make sure to hit that like button, also subscribe to my channel. In this video, we will talk about 5 reasons why your credit score is at risk. So make sure to watch the full video. 1. Late or missed payments. Late or missed payments can significantly impact your credit score and put it at risk. Your payment history is one of the most crucial factors that credit bureaus use to calculate your credit score. It accounts for approximately 35% of your overall credit score. When you make a late payment or miss a payment, it can negatively impact your credit score in several ways. First, the creditor may report the late payment to the credit bureaus, which can stay on your credit report for up to 7 years. Late payments can cause your credit score to drop, making it more difficult to obtain credit in the future. In addition to affecting your credit score, late payments can also result in late fees and penalties, making it more challenging to pay off your debts. Late payments can also lead to higher interest rates, which can result in higher monthly payments and make it more difficult to manage your finances. To avoid late or missed payments and protect your credit score, it's essential to create a budget and ensure that you have enough funds to cover your bills each month. You can also set up automatic payments or reminders to ensure that you don't miss a payment. If you are struggling to make payments, you can reach out to your creditors to discuss your options, such as setting up a payment plan or refinancing your debt. 2. High credit card balances. High credit card balances can put your credit score at risk. Your credit utilization rate is the percentage of your available credit that you are using. It is a significant factor that credit bureaus use to calculate your credit score, accounting for approximately 30% of your overall score. When you carry high balances on your credit cards, it can indicate that you are not managing your credit responsibly. It can make it appear as if you are relying too heavily on credit and may have difficulty paying off your debts. Having a high credit utilization rate can cause your credit score to drop, making it more difficult to obtain credit in the future. Creditors may view you as a higher risk borrower, and you may be offered higher interest rates or be denied credit altogether. To avoid high credit card balances and protect your credit score, it's important to keep your credit utilization rate low. Experts recommend keeping your balances below 30% of your available credit. If you have high balances, it's a good idea to develop a plan to pay them down. You can consider making larger payments or increasing your monthly payments to reduce your balances more quickly. Another option is to consider transferring your balances to a credit card with a lower interest rate or applying for a debt consolidation loan. These options can help you reduce your interest rates and make it easier to pay off your debts. However, it's essential to do your research and compare options carefully before making a decision. 3. Applying for new credit. Applying for new credit can put your credit score at risk. Each time you apply for credit, it results in a hard inquiry on your credit report. Hard inquiries can negatively impact your credit score and stay on your credit report for up to 2 years. When you have too many hard inquiries on your credit report, it can make it appear as if you are actively seeking credit, which can be a red flag to creditors. It can also indicate that you may be having difficulty managing your finances, which can negatively impact your credit score. Applying for new credit can also affect your credit utilization rate. If you are approved for new credit, you may be tempted to use it, which can increase your credit utilization rate and put your credit score at risk. To avoid applying for new credit too frequently, it's important to be selective about the credit you apply for. Only apply for credit when you need it, and avoid applying for multiple credit cards or loans at the same time. It's also a good idea to check your credit report before applying for credit to ensure that it is accurate and up to date. If you notice any errors on your credit report, it's important to dispute them with the credit bureau to have them removed. Overall, being responsible and mindful when applying for new credit can help you protect your credit score and maintain a healthy credit profile. 4. Closing credit accounts. Closing credit accounts can potentially put your credit score at risk, depending on the circumstances. Your credit utilization rate and length of credit history are 2 factors that can be impacted by closing credit accounts. When you close a credit account, you decrease the amount of available credit you have, which can cause your credit utilization rate to increase. Your credit utilization rate is the percentage of your available credit that you are using, and it is a significant factor that credit bureaus use to calculate your credit score. If you have high balances on your remaining credit accounts after closing one or more, it can increase your credit utilization rate and negatively impact your credit score. Closing an old credit account can also impact your length of credit history. The length of your credit history is the amount of time that you have been using credit, and it is also a factor that credit bureaus use to calculate your credit score. Closing an old credit account can shorten your length of credit history, which can negatively impact your credit score. However, there are situations where closing a credit account may be necessary or beneficial. For example, if a credit account has an annual fee that you no longer want to pay, closing the account may be a good decision. Additionally, if you are struggling to manage your credit and find yourself in debt, closing credit accounts can help you limit your available credit and reduce the temptation to overspend. Overall, it's important to weigh the potential risks and benefits of closing a credit account before making a decision. If you are unsure whether closing a credit account will impact your credit score, you can consult with a financial advisor or credit counselor for guidance. 5. Identity theft. Identity theft is a serious threat to your financial well-being and can put your credit score at risk. Identity theft occurs when someone obtains your personal information and uses it to make unauthorized purchases or open credit accounts in your name. If someone steals your identity and opens new credit accounts in your name, it can negatively impact your credit score. The thief may max out credit cards or take out loans that you are unaware of, which can result in missed payments and increased debt. These negative actions will be reported to credit bureaus and can lower your credit score significantly. In addition to impacting your credit score, identity theft can also make it difficult to obtain credit in the future. If your credit history is negatively impacted by the identity theft, it can take time and effort to restore your creditworthiness and convince creditors that you are a responsible borrower. To protect yourself from identity theft, it's important to take steps to safeguard your personal information. This includes regularly monitoring your credit report for any unauthorized activity, shredding important documents, and being cautious about sharing personal information online. If you suspect that you have been a victim of identity theft, it's important to take action immediately. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.